Hi, welcome to Christensen Wealth Management and the weekly chart review. This is part 2 of this week's weekly stock market update. I did the first part with a commentary and history lesson about bear markets, and this is a breakout session of just the charts that I wanted to show you for the week. Let's go ahead and jump into those charts, and we'll begin with the Dow Jones, S&P 500, and NASDAQ, and I'll show you a few industry sectors as well. Let's take a look. Looking at this chart of the Dow Jones Industrial Average from January 1st, 2018 until January 4th, 2019, you can see that we're still in a pretty substantial declining trend for the Dow Jones, and we've had about a 7% bounce off this low on Christmas Eve, which is a very significant bounce. However, if I change this over to a candlestick chart, I will show you each one of these marks. It represents the high, low, open, and closing price of each trading day for the Dow. And the low of February 9th was 23,360. And if I draw a line right there at the low of February, let me do that. That represents significant resistance for the Dow, and it also lines up with the low of April 2nd, 2018. And as of right now, we've tested that several times over the last week. Once on the 28th of December, once on the 31st, this week on January 2nd, and then today. We are still above it as of the recording of this video with about 1 hour left in trading. So we'll see if the Dow can close above that. That would be an interesting scenario. But one thing that I've got my eye on is the fact that the decline from the high of December 3rd could in fact be a very bearish, what we call a flag formation. I'll draw the flag in here for you. This is the flagpole, and then if I draw the actual flag itself, you can see that we've got one potential line there, and then the other line about like that. And this, why don't I go ahead and finish the flag real quick. There we go. So if that is a flag, that means that if this does fail and the bear market continues lower, in the textbooks anyway, the continuation of this bear market flag pattern could be the length of the flagpole to the downside. So let's measure that real quick. And if that is true, the high of December 3rd down to the lows of Christmas Eve was about 16%. So if this pattern fails or does come true and we do make another leg down, then the Dow Jones Industrial Average could drop another 16%. So that's why I say just continue to use caution, because we are not out of the woods yet. We have the February low, the April low causing significant resistance to the upside, and to the downside is the possibility of another 16% decline continuation for the Dow. Let's zoom out though a few years and I'll show you what the 9-year trend line looks like real quick. Here's a chart of the Dow Jones from November 2008, and I drew a line from the low of February 2009, which was the bottom of the financial crisis and our last bear market, and you connect it with the next point right here of October 3rd, 2011. We touched it and broke it several times during the crises of 2015 and 2016 when we had two 10% drops back to back. And then if you draw that on up here, we touched it exactly to the almost to the penny on Christmas Eve. So the Dow Jones Industrial Average is still on a 9-year trend. However, if this line breaks, then like I said, if this line breaks, then we're definitely going lower. Well, I don't want to say definitely going lower, but there's not a lot of support below this red trend line until we get down to the highs of right here, which would be about August 2016 at 18,500 for the Dow. And that's a long way to go. It'd be about another 20% drop or so for the Dow Jones. So be careful. Caution still in this market, especially looking at this Dow Jones chart. Looking at this chart of the S&P 500 stock index, same story, significant decline that we're still in. And the bear flag, if I can change this over to a candlestick chart, again, we've got the potential bear flag scenario from the December 3rd high down here to Christmas Eve. That's the flagpole. And as I also said, if we connect these points here, this is the potential flag itself. A little rough around the edges, but you get the idea. That could be the bear flag. If that does become a bear flag and the S&P 500 does fail to continue higher, then we could have another leg down for the S&P of about 16% from where we are today as of the recording on January 4th. So 16% is a long way to go down. And a few things here that could be standing in the way are the lows of February and April, I believe. Let me draw those lines in. This red circle on the left represents the low of February 9th, 2018. And if I draw that line across like I have, you can see that as of today, January 4th, this big green candlestick came up, broke that line, and has so far pulled back below it. So right now, the lows of February are holding as resistance. And if we fail to close above it, then that is potentially a not so good sign for the S&P 500. So seeing that we have slammed into some pretty powerful resistance to the upside, basically a concrete ceiling for the moment, I would be very careful going forward for the rest of January, because if this does turn bearish, there could be a 16% continuation to the downside, and that is a pretty large drop by anyone's standards. Let's quickly zoom out and I'll show you the 9-year trend on this chart as well. Having drawn a line from the low of March 2nd, 2009, you can see that the line touches here, August 2011, touches here, September 2011, touches here, November 2011, and then in here, January 2016 and February 2016. And as of last week, on Christmas Eve, we came down perfectly, and you can see this green candle. We came all the way down and tagged that red line almost perfectly. So we came back and rejoined the 9-year trend line of the S&P 500 on Christmas Eve and bounced off it. So we'll have to see if the market, the S&P 500, just continues higher. But as I already said, if it doesn't and it gets stopped right here, there could be a 16% drop to go lower, and that would take us down to, from where we are now, 16% would be perfectly just what I was thinking. It actually takes us down to the highs, which just happened to correspond to very strong support. May 2015, right here. This line is where the S&P 500 would find its likely support if it broke through and headed lower and made that 16% run, because that's exactly where we go, is the high of 2015. So very, very much caution, significant caution is recommended in this market right now, and better to be safe than to go down 16%, in my opinion. The last chart of the day is the NASDAQ 100 stock index, which is heavily weighted toward technology stocks. And this is a chart going back and capturing the beginning of 2009. So it's this line begins on about March 2nd, 2009, and you can see we touched it several times here. August of 2011 and September 2011, November 2011, in through here, November of 2012 and December 2012, April 2013, right here as well, February 2016, And then once Trump got elected, well, I'll just go ahead and draw a line from that the NASDAQ began on June of 2016. You draw that line up. That's what the NASDAQ was following for 2.5 years, and then it broke it back here in October and has since fallen. Let's see how far it's declined. It's gone down about, as of the recording of this video, we're down about 16% on the NASDAQ, but there's not a whole lot of support at all. And right now for the NASDAQ, we have the same February low right there, and we actually are above it right now. So there's some decent short-term strength in that particular, at least I think that's February low, yeah. But if I move it up to the lows of April, that's probably the next area of resistance. But to wrap up this video, if the NASDAQ turns lower, like I was saying on the Dow and S&P, then to get down to that 9-year trend line, it's got to go down about another 20%. So that's a pretty steep run, considering that if you measure it from the high down to that lower trend line, that would be a decline for the NASDAQ of 33%. And we're only halfway there right now. So be very careful with the technology sector and with anything related to the NASDAQ 100. Thank you for watching this chart recap for the week, and I wish you a great week ahead and weekend.